everybody, today we will talk about ETF funds. Foreign exchange traded investment funds whose securities are traded on the stock exchange, or in other words, a transparent package in which you can buy the entire market as a whole. Invest in all securities included in the corresponding index throughout a brokerage account. If you would like to diversify your investment by buying a basket of securities included in relevant index, ETF funds for you. Most ETFs are index funds, that is, they hold the same securities in the same proportion as a certain stock market index or bond market index. The key differences between index ETFs and index funds are that ETFs trade throughout the day while index funds trade once at market close. ETFs are often cheaper than index funds if both commission-free. Index funds often have higher minimum investment than ETFs, and ETFs are more tax efficient than mutual funds. ETFs are similar in many ways to mutual funds, except that ETFs are bought and sold throughout the day on stock exchange. An ETF holds assets such as stocks, bonds, currencies, and commodities such as gold bars, and generally operates with the arbitrage margin designed to keep it trading close to its net asset value, although deviations can occasionally occur. An ETFs is a type of fund that holds multiple underlying assets rather than only one, like a stock. Because there are multiple assets within an ETFs, they can be a popular choice for diversification. An ETF can own holders or thousands of stocks across various industries, or it could be isolated to one particular industry or sector. Some funds focus only on USA offerings, while others have a global outlook. For example, banking-focused ETF would contain stock of various banks across the industry. Since most ETFs are index funds, they incur low expense ratios because they are not actively managed. In index funds, it's much simpler to run since it doesn't require security selections and can be done largely by computer. In addition, unlike mutual funds, because ETFs don't have to buy and sell securities to accommodate shareholder purchases and redemption, and ETF doesn't have to maintain a cash reserve for redemption and sales and brokerage expenses. ETFs typically have extremely low marketing, distribution, and accounting expenses. Let's take a look what is mutual funds actually for better understanding the difference. Mutual funds are investments that pool your money together with other investors to purchase shares of a collection of stocks, bonds, or other securities, referred to as a portfolio that might be difficult to create in your own. Mutual funds are typically overseen by a portfolio manager. The price of the mutual funds, also known as its net asset value, is determined by the total value of securities in portfolio divided by number of the fund's outstanding shares. This price fluctuates based on the value of the securities held by the portfolio at the end of each business day. Note that mutual funds investors do not actually own the securities in which the fund invests. They only own shares in the fund itself. In the case of actively managed mutual funds, the decision to buy or sell securities are made by one or more portfolio managers, supported by teams of researchers. A portfolio manager's primary goal is to seek out investment opportunities that help enable the fund to outperform its benchmark, which is generally some widely followed index such as the Standard & Poor's 500. Note that while it may be tempting to focus on short-term performance, When evaluating a fund, most experts will tell you that it's best to look at a long-term performance, such as 3 and 5 years returns. So both mutual funds and ETFs offer investors pooled investment product options. Mutual funds have more complex structuring than ETFs with varying share classes and fees. ETFs typically appeal to investors because they track market indexes. Mutual funds appeal because they offer a wide selection of actively managed funds. ETFs actively trade throughout the trading day, while mutual fund trades close at the end of the trading day. Mutual funds are actively managed, and ETFs are passively managed investment option. There are various types of ETFs available to investors that can be used for income generation, speculation, price increases, and to hedge or partly offset risk in an investor's portfolio. Here we can see several examples of the types of ETFs. Bond ETFs might include government bonds, corporate bonds, and state local bonds. Industry ETFs track a particular industry such as technology, banking, or oil and gas sector. Commodity ETFs invest in commodities including crude oil or gold. Currency ETFs invest in foreign currencies such as the euro or Canadian dollar. Inverse ETFs attempt to earn gains from stock declines by shorting stocks. Shorting is selling stocks, expecting a decline in value, and repurchasing it at the lower price. Investors should be aware that many inverse ETFs are exchange-traded notes, ETNs, and not true ETFs. An ETN is a bond but trades like a stock, and it backed by an issuer like a bank. To be sure to check with your broker to determine if an ETN is a right fit for your portfolio. American ETFs have been available in USA since 1993 and in Europe since 1999. ETFs had their genesis in 1989 with index participation shares and S&P 500 proxy that traded on the American Stock Exchange and the Philadelphia Stock Exchange. This product was short-lived after a lawsuit by the Chicago Merchants Exchange that was successful in shopping sales in the United States. In 1990, a similar product, Toronto Index Participation Shares, which tracked the TCE 35 and later the Toronto Stock Exchange 100 indexes, started trading on the Toronto Stock Exchange in 1990s. The popularity of this product led the American Stock Exchange to try to develop something that would satisfy regulation by the Securities and Exchange Commission. The SEC generally requires ETFs to be transparent, and issuers generally are required to publish the composition of the ETF portfolios daily on their websites. However, the SEC does allow certain actively managed ETFs to be non-transparent. They don't have a disclosure exactly that they own. ETFs are priced continuously throughout the trading day and therefore have price transparency. So what are benefits of investing in ETFs? It is easy of trading and accounting. ETFs are traded like ordinary stocks. Access to international markets using a standard brokerage account. Online transparency of ETFs investment portfolio structure. Also, the ability to implement both passive investment strategies and active management strategies, arbitrage pricing, and hedging. Low initial investment, wide diversification, and high liquidity, the ability to buy and sell assets at any time. Wish you profitable investment strategies. Keep going, master the necessary knowledge, and stay wealthy. See you soon.